Hello trade pros, and welcome to another video on position sizing as a professional trader. In the first video, I explained to you how to size your position accordingly when you're in a trend market environment. In today's video, I'm going to dive in and talk to you about the second part of market structure, ranging markets. This is where a lot of traders give up profit when the markets aren't moving and slowly bleed out their account when we're stuck in a consolidation. However, consolidations are 70% of the time in markets, so it's important you understand and know how to trade these conditions the right way. So in this video, let's dive right in and talk about range trading strategies and how to position size accordingly. Let's dive in and let's go. But before we do, please hit that like button and also subscribe and hit the notifications bell to receive updates, because we put out good content every single day that you're not going to want to miss. So let's jump in. All right, so the very first thing you want to keep in mind is that in order to trade a range, you have to know how to identify when that range is about to form. So when you're in a nice trending market like this, and what you're looking at is called a 10-tick chart. So this is a range bar chart. It is not dependent on time. I love range bar charts because they consolidate much cleaner and it strips away the element of time, which at the end of the day is a human construct. The market doesn't care about time, cares about price and volume more so. So using this 10-tick range bar chart, you're able to see the trend definition much cleaner. So what you could look at on a bullish market like this, where you're seeing higher highs and higher lows extend, all right, you're looking at a level below to identify where this horizontal range can form. Any prior low is an opportunity for the market to get back there and pick it up as support and to stick above it and to hold that level as a support, and overhead that prior resistance to hold. And this is where the range is actually going to develop within. So what's important is that a range is when a market is stuck in between two levels and rotating or building out value. Now, it's important for the market to do this because value is what determines whether or not we continue to go up or down. So you want to identify a range, and to be able to identify a range, you have to get extremely good first at being able to draw levels. And so you should go practice levels, because those levels are going to be the basis on which you could trade the range. All right, so to be good at doing levels, you got to get really good at doing analysis. So here's the situation. When you're getting a consolidation, it often doesn't happen in isolation. Let me pull up a paint or a white screen so I could demonstrate this to you, okay? Before we jump into the charts, when you see a consolidation, it often doesn't happen by itself in an isolation movement. This consolidation is either from a downtrend, which is now consolidating or taking a bit of a pause before likely continuing, or this consolidation is occurring in an uptrend. And the reason it's key to identify what led or what direction the market was going before we started ranging or moving sideways, consolidating, back and filling, whatever terminology you want to use, it's all the same. Knowing the direction it came from gives us a higher likelihood that that will be the direction it exits that range as well. So even though it's sideways, the speed and the direction of which it came into that range is pretty indicative of the speed and direction of which it will exit in a nice trending market. So let's take a look at the chart now with that knowledge and identify this. So first and foremost, we are day traders. So most recently, this momentum here has been to the upside. All right, you can see the prior day was pretty bearish. That was a downtrend, but now it has converted to an uptrend because you're putting a series of higher highs and higher lows. So now that you know it's an uptrend, you expect to see a consolidation at some point. So we trade down to this prior low, all right, and this prior low. And because they're pretty close, you would assume here on the ES futures, this is a futures chart of the S&P 500 market. All right, you would assume that a consolidation would form somewhere around this 42 level. So we have a test down, okay? We go up and we fail to break the 56. So now the consolidation is on as long as this 44 holds. So what you could do here then is to draw a level where you see a developing range, all right? And you just do it by putting yourself a little box here. and saying to yourself, okay, so this is going to be likely where the range is forming. And because we're bullish, all right, we want to see this range hold, but ultimately break above the 56 and keep going up. This is a pause to the bull trend. If it breaks the support, you might have a new downtrend forming, but that's not important. The important part is to identify two levels where you see that there is a support level where there's demand of buying and a level where you see a resistance where there's an overhead supply. Now you could trade this level because it's hit there 1, 2, 3 times and worked, and it's hit a resistance 1, 2, and almost a third time here. This range is on. The idea now here is to work that level. This is called leaning on the level. And what does it mean? Institutional traders do this all the time, is accumulate a position near the lows and distribute near the highs if you would like to get out of this trade. So the idea here is we'd be getting long the 44, all right? And we are looking to, let me get the crosshair tool open, getting long around the 44 to 45 with a stop below the 40 even, below the 41, because that's the bottom of the range. All right, so let's get the hand tool out and let's move over. Okay, so we've got our first position. Now, this is how the position sizing starts to, this is officially the entrance into position sizing. You have two options here, is to buy a small amount of contracts, all right, and as it approaches the resistance, to sell them, to turn a little day trade on for yourself, or you have the ability to buy multiple contracts. So let's assume we bought 4 contracts here at around the 44 level, and we're risking 4 points per contract, all right? Because if we get below the lows, we're out of this position. If we bought 4 contracts, what is our target? Well, it's the top of the range, and you could see there's a resistance at 52 and 55, but we're just targeting a simple move to the top of the range before we get out, all right? So here we take some heat on that position instantly. We go down to the 42. We're still within our range, so we're still on the long side, all right? And the market runs up to where? All right, you approach the 54 to 55. Now, this is an important conversation to have because many traders in this situation, I'm going to just zoom in a little bit, will get greedy. They say, hey, I got long the 44 here, and now I'm up, but I'm going to get another 10 points, and now it's going to go to the moon, and I'm going to just forget about it. The important part about range trading is that you get long near the supports, but always remember to get paid near the resistance. So if you had 4 contracts here, sell half the position, take 2 or 3, whatever your strategy is, all right? Get paid on that resistance because it's failed once, it's failed twice, and you don't know that it isn't going to fail the third time. Always get paid when you have profit, because if you're not going to get paid when you have profit, when will you get paid? It's always easy when you're long to anticipate a breakout, but you got to remember the best place to get paid is right where a prior resistance had formed. So here around the 54, you're going to be looking to get out of 2 contracts. So 2 contracts times 10 points, that's a 20-point winner right here that you realize at this point. Now, you have 2 contracts long from the low of that range with a stop below it. Should you keep your stop here? Absolutely not. On a position that's in profit at 10 points, you want to start thinking about obviously moving your stop. What I like to do is place a stop in a range below the middle point of that range. So if 55 is the high and 44 approximately is the low, all right, that's about 11 points. 5.5 points from the high or from the low is the middle point. All right, and I'd like to use that as a support level and placing your stop below. Now, if you want to accumulate size and you're a longer term position trader, you could put your stop loss at break even and wait for a pullback in this range. So as you can see, it breaks, all right, on this range, comes back. If you're a day trader, the momentum's over, your stop's been activated. But if you're trading ranges the way I'm focusing on this video, you're actually looking to add some size again. So you had 4 long here, you took 2 of profit around the top of the range. Now that it's returned to your support, you could add another 2 as long as the range support is holding. All right. And then you're back now to 4 contracts. So as it goes down to that level, all right, and you get activated here on another position long, now you're back to 4 long with 20 points of realized profit. All right. And you watch the market go towards the high of the range. What do? Once again, you repeat the trick and you sell out of the 2 at the resistance because it may break out, but we aren't selling our position because we think it's going to break out. We're selling our position because there's a chance, and this means there's risk associated with it, that it doesn't break out and it comes back down. We have a profit. We have to turn that profit into a paycheck. So what we do is we sell another 2 at the top of this range. Okay, so what we've done now is we've taken 2 contracts of profit here, 4 long, 2 contracts of profit. That's 20 points locked in. We added another 2 at these lows. All right, and now we're scaling out for another 2 contracts for another 20 points of profit. Meanwhile, we've had a 2 lot long from the very base of this trade. That's the core position. All right, why are we keeping the 2 contracts long? Why don't we just sell the whole thing? Well, we're keeping it long because this consolidation happened in a bullish trend. All right, and we're playing the direction of the trend preceding the consolidation because that's our expectation of where it will go after it breaks. So these 2 contracts are really what we call a runner in trading. We want to keep a runner in case we break that resistance, but we're not putting in more money at lows and not taking profit. We're trading the range by buying the lows and selling the high of the range, and we're leaving an optional 2 lot runner to go into the extension of the direction that led into this consolidation, which is bullish. So we approach this resistance. We've got paid on 2 contracts. What happens? All right, we pull right back down to that support level. What do? We do it again. We buy it again, another 2 contracts. So we're back to having 4 contracts long. And this time, what happens? It breaks through that resistance. And even though I know it's broken the resistance, all right, it doesn't matter. The advice doesn't change. You still should have sold 2 here. So what would have happened here is this is our 3rd time selling a 2 lot profit on 10 points. Now we have 60 points banked. And on the 2, we have a runner. Once the range breaks out, you now want to start moving your stop a little more aggressively, at least to the middle, all right, and likely even higher to the top of the range. You don't want the market to come back in a range. You want to run this thing for some more upside profit, all right? Until where? Where is your target? Well, you want to go back in the past and find a previous high that you could target and sell right below. Now, if we zoom out far enough, all right, where was that previous high in this sequence that we're using this example? Around these 76s. So what do? We're right there right now. And in fact, not only are we right there, we're seeing some rotations and a sign that we might enter into another consolidation or even a pullback and jeopardize our profits. So this is a great area to get rid of the last 2. So 3 times we were able to take 2 contract positions, all right, and get 10 points on each, which is a 60-point profit. And the last 2, we were able to run from the bottom of the range all the way to the break and a prior high, which gets us from about 48 to 73. All right, that's another 20 points on 2. That's 40 plus the original 60, trading the range by buying the lows, selling the top of the range, and leaving an optional breakout position is giving you the ability to capitalize on 100 points, which is $5,000 on the ES futures market. Now, we only held a 4 contract position at the max, right? So each contract is $100 or $500 of margin. So we were able to do that with a $2,000 margin outlay, and we risked only about 4 points on that entire position on 4 contracts. And so this is the important part about the range. I want to summarize a few things for you, and then we'll wrap up this video because this is why I wanted to do as part 2. I didn't want to rush this process. So a few things you want to understand about range. Ranges happen in trending markets. All right. There are moments where they range and then they continue. These ranges are tradable. What you want to do is 1, 2, or 3 hits of a support, draw it. 1 or 2 hits at the top forms a resistance. You want to buy the support and sell before you hit the resistance on part of your position and leave a runner for the break and continuation. All right. You want to get paid before the resistance. You don't want to get greedy. The next time you see a range, all right, you do the exact same thing and you repeat it. Also, remember about a range. It's not arbitrary. It's often a continuation from the trend that brought it there. So if we're bullish into the consolidation, bullish break and continuation is expected in a bullish market. All right. In a bearish market, which lasts much shorter periods of time, but it's more fierce and violent. All right. A bearish leg down into a consolidation is usually a bearish break and continuation. All right, so consolidation tends to lead to continuation. Now, why did I tell you to get paid near the tops? Let's do this example again. Imagine buying 4 contracts and you get to the resistance and you don't get paid. You have a 10-point profit, and instead you watch the position come against you. It hits the support, and instead of it working the way we discussed, it breaks. Because this does happen. There's no trading that's 100% accurate. This will happen to you in range trading. All right. And now you've seen 40 points evaporate. And not only did you not get paid, you lost money when you had $2,000 of open profit, which is what 40 points is. Inexcusable, unacceptable, and you'll never be a professional trader doing that by holding an open position, hoping for more. The play is always buy the support, all right, slightly above the support, and sell slightly below the resistance. All right, you don't want to wait for the resistance, sell slightly below it, get paid a little bit less, but you're going to be paid first. And by repeating this process, whether or not the range holds and breaks, it doesn't really matter because you're getting paid the opportunity you get to. And when you get stopped out on this support, you're not losing your you're not losing your initial capital. You're losing part of the market money you've already locked in by selling at the resistance. So always remember, buy slightly above support and sell slightly below resistance. It'll give you a chance to get paid. It'll give you a chance to load up on the trade without increasing risk. You can double dip in a range, and you're on board for the breakout, for the continuation. This is how you take a range and you make it the backbone of opportunity for the next continuation or breakout up. So this is where most traders think the money's made, on the breakouts. But the idea is to be loaded up on the range and participate on the breakout and not be looking to get in, but scaling out and looking to get paid. So that's how you take a range, which occurs 70% of the time, and convert that into an opportunity for a trend continuation, but not all in, getting paid in the range and leaving yourself a profitable runner at absolutely no risk in a position that's already paid you. And even if you lose this runner, you're still profitable and up ahead. So hopefully this has been helpful. This is how you trade a range. This is how you average into a range and how you lean on the level in the industry. Now, if you're extremely bullish, I'll just mention this very quickly. There are situations under which you could keep adding contracts here. So 1 contract plus 1 more for a total of 2, plus 1 more for a total of 3, 4, etc. And keep loading it up on these support levels, hoping for a breakout. All right. But you still want to, at some point with this strategy, incorporate a place where you're going to get paid even in a range, because loading up at the lows like this without getting paid, when it works great. But when you get stopped out, you've wasted a lot of time and you've wasted a lot of potential to have gotten paid numerous times. And that's not how you build a winning mindset. You have to get used to walking away from the market with profit. And when you have an opportunity, you got to get paid. You could always scale in later. Hopefully this has been a helpful video. I'm really excited about doing this one with you. And hopefully you've learned a ton. In our course, we include another edge that you could use for your strategy, which is order flow, and teaching you how to find where institutions are buying and when, and using that information to time your entries even more precisely with less risk and more opportunity. Check that course out at TradeProAcademy.com. It's called the Futures Day Trading and Order Flow course. Thank you guys for watching, and I hope you've learned a ton here from this strategy. All right, trade pros, and there you have it. Hopefully you've enjoyed this video on learning how to trade ranges. This happens 70% of the time, so now you're prepared to not miss any more opportunities and not need markets to move to be profitable, because that's a significant crutch. If you want to take this a step further and learn how to apply more advanced order flow application and find high probability, low risk trades in any market condition, check out TradePro Academy and our order flow and futures day trading course. You can find that on our website and go a step deeper and learn truly how professionals trade on every single day basis and how they find success given and regardless of any market conditions. Thank you for watching. Remember to hit that like button, subscribe to our channel, and be sure to hit the notifications bell so you're alerted when we come out with new videos daily. So thank you once again. Thanks for tuning in. Manage that risk, and always remember, trade like a trade pro. Take care and goodbye. I'm going to turn around and get back to the markets. Have an awesome day.